Joining me from our studios in Cape Town is Patrice Rassou. He's the head of equities at Sanlam Investment Management. We're going to be taking a look at the banking sector and those particular equities, and it's only fitting that we look at Capitec that was out with their results today. Patrice, thanks for your time. Looking at Capitec, they've been able to weather the storm of the demise of African Bank Limited and also the Moody's downgrade. What did you make of this particular set of results?
Yeah, it's very interesting. I think the market towards the second half of last year was quite concerned that there would be contagion from African Bank to other unsecured lenders like Capitec. And in fact, the mood has changed completely. Now Capitec is seen as the last man standing in the unsecured market and seen as being able to dominate that market even more without having the competition from African Bank, and also with the bigger banks, the big four banks, having withdrawn to a considerable extent from the unsecured lending. So they seen net as the winner. We saw that in the share price, going up substantially even before the trading update and the results, and now this is being confirmed further by a sterling set of results which came up at the upper end of the trading guidance at 26% earnings growth, which is not really common in the current environment and definitely not within the financial sector. So it's a real sterling set of results, very strong numbers which have come through.
It's interesting because you talk about the current economic climate. The CEO was on the earlier show, Power Lunch, and he spoke about how he still has faith in the South African market. And although they're sitting at a market share of 16%, he is looking to grow that. Can they do this?
What's quite interesting, they already have over 6 million retail customers. But what you should look at is what is called in banking primary customers. It's the main bank account that customers have where they have their salaries deposited at the end of each month. And a third of the Capitec customers, about just under 3 million customers, are primary clients of Capitec, and that's growing quite strongly. We're talking growth of just under 100,000 per month. And they are neck and neck with Nedbank in terms of being the fourth retail bank. They probably would argue already that they in the big four when you look at retail banking in South Africa, which is pretty amazing, which for a bank which has been formed, just a decade ago, and now, rivaling the big four, which have been around for a large number of years. So I think they can do it from that point of view in terms of continue to acquire customers, offering a very simple, easy to understand product, priced extremely well, the cheapest in the banking sector, and very clever advertising which resonate with the man in the street, which often we see banking and financial services as complicated, difficult to understand, whereas they've come with the whole idea of simplicity being the ultimate sophistication, and that seems to be really attractive in terms of a value proposition.
Well, we have seen Capitec weather the storms that we've mentioned earlier, but when it comes to the global events that are taking place, if we look at the central banks, quantitative easing that's kicked off and for the ECB or by the ECB, and then we're looking at the US Federal Reserve that's looking to increase interest rates. What is that likely to do for the banking sector in South Africa, and of course also looking at the outlook for Capitec?
It's an extremely good question because we've been in an unprecedented era of cheap money and, really low interest rates. We're talking millennial low interest rates, definitely in Europe, in the US, and indirectly in South Africa, with the Reserve Bank having been able to keep interest rates fairly low for an extended period of time. And the whole issue with QE is, and the question that the markets are asking themselves is, will the Fed lead the way with an increase in interest rates? Will it mean the end of QE, the end of cheap money, and will that have a knock-on effect in terms of our own Reserve Bank, in terms of future increases in interest rates? Because it's quite clear if you're a borrower, low interest rates makes any loans more affordable. But for Capitec, your question links it to Capitec. I think there's two implications. On the one side, you must remember that on the unsecured lending loans are not really floating rate loans. They tend to be linked, they tend to be fixed, and they tend to be linked to prime. So I think the impact will not be as marked as one would expect with a normal mortgage loan, for instance. So it's not going to be a direct impact. But the reality is when interest rates goes up in the economy, you tend to have liquidity being less plentiful and moving away maybe from the banking system, and it becomes a bit more difficult to borrow. So for most banks, you'll find it that it will become a question of affordability when interest rates go up, where it'll be a lot more difficult to lend, and you might then have 9 months or a year down the line after interest rates have gone up, not 50 basis points, maybe 200 or 250 basis points, an increase in retail bad debts. That's not the case now. I mean, even the Capitec results are showing that bad debts are very well maintained. But if that changes, if interest rates start to rise across the globe, that will change the environment within which banks operate.
Oh, thank you so much, Patrice, for that analysis. That was Patrice Rassou. He's the head of equities at Sanlam Investment Management.